Every single day, millions of trucks, cars, and vehicles drive on India's national highways. Every vehicle pays a toll. Every toll goes to the highway operator. And every quarter, if you are smart about it, a portion of that toll comes directly to you. Not as a highway builder, not as a government contractor, simply as an investor, sitting at home holding units on your phone. This is an InvIT Infrastructure Investment Trust. And today I am going to give you the most complete, most honest, most beginner friendly guide to InvITs that exist on the internet. We'll cover everything, what it is, how it works, how much you need, what returns to expect, which are the best InvITs in India, risks, taxation, how to buy, how to sell, everything. Stay with me till the end, and this could change the way you look at investing in India's infrastructure story. So, first, let us begin with the opportunity. So, let's start with a big picture thought. Um, India is building at a pace the world has already rarely seen. So, the National Highway Authority of India is building roads at record speed. India's power transmission grid is expanding massively. Gas pipelines are being laid across the country. Airports, ports, and railways are all being modernized. This infrastructure boom is one of the India's biggest economic stories of the 2020s. But here's what most retail investors don't realize. You don't have to just watch this boom from the sidelines. You can actually participate in it and earn income from it. That's exactly what InvIT allows you to do. An InvIT, Infrastructure Investment Trust, is a SEBI regulated investment vehicle that owns and operates large infrastructure assets, highways, transmission lines, gas pipelines, and more. Just like a REIT owns commercial buildings, and InvIT owns infrastructure projects. And just like a REIT distributes rental income, and InvIT distributes toll revenue, transmission charges, and pipeline fees to investors every quarter. So in India, InvITs have been available since 2014 when SEBI introduced the framework. Today, there are multiple listed InvITs covering roads, power, and gas infrastructure. And here's the exciting part. India's government has committed to spending over triple 1 lakh crore on infrastructure through the National Infrastructure Pipeline. That is 111 lakh crores. And the asset that feed these InvITs will only grow in value and volume over time. Let's understand this investment from scratch. So, coming to what is an InvIT? So let me explain InvIT using the simplest possible analogy. You know how a highway toll works, right? A vehicle drives through, it pays a toll, that toll goes to the highway operator. Now imagine you could own a tiny fraction of that highway and collect a tiny fraction of that toll every single day. That's what an InvIT does for you. Step by step, how an InvIT works is step 1, a sponsor company. Typically, a large infrastructure conglomerate owns multiple operational infrastructure projects like highways, power lines, pipelines, etc. Step 2, these projects are transferred into a trust structure, the InvIT, which is regulated by SEBI. And next we have step 3, that is the InvIT is listed on NSE or BSE and units are made available for public investment. Step 4, you buy the units just like buying a stock and become a co-owner of the underlying infrastructure assets. Step 5, that these assets generate steady, predictable cash flows, toll revenue, transmission charges, gas pipeline fees, etc. Step 6 is by law. So, by law, what you'll be doing is that the InvIT must distribute at least 90% of its net distributable cash flows to investors every quarter. And step 7 is the what you say, the you receive quarterly distributions directly in your bank account as long as you hold the units. So the key legal requirement here is, just like REITs, InvITs are mandated by SEBI to distribute 90% of their net distributable cash flows every quarter. This is not optional, it's the law. And what makes infrastructure special is that infrastructure assets are unique. And like a company, infrastructure assets don't go to zero. A highway that exists today will still be there in 20 years collecting tolls. A power transmission line signed on a 25-year concession will generate revenue for 25 years. This predictability is the core strength of InvIT income. The simple analogy here is that think of InvIT as owning a toll booth. Every vehicle that passes pays you a small amount. You don't drive the vehicles, you don't maintain the road. Professional managers do that. You just hold the toll booth unit and collect money every quarter. Now, let us see the differences between InvIT versus REIT. The key differences. So, since many of you might already know about REITs, let's quickly clarify how InvITs differ. Coming to the underlying asset, InvIT has roads, power lines, and pipelines, where REITs have office parks and malls. Coming to revenue sources, InvIT has tolls, transmission charges, and REIT has rental income. Coming to asset life, InvIT is 15 to 35-year concession, and REIT has ongoing, that is renewable leases. Coming to risk type, InvIT has traffic or volume risk, and REIT has occupancy or vacancy risk. And coming to returns type, InvIT has higher yield up to 8 to 12%, and coming to REIT, it has moderate yield like 6 to 8%. Coming to India options, InvIT has 6 plus listed InvITs. Coming to REITs, India has 5 listed REITs. Coming to sponsor type, InvIT has infrastructure companies, and coming to REITs, it has real estate developers. So InvITs generally offer higher distribution yields than REITs because the infrastructure assets tend to have longer concession periods and more predictable, but sometimes volume dependent cash flows. Next, we have types of InvITs in India. So, in India, InvITs cover three main infrastructure categories. Type 1, road or highway InvITs, and these own operational toll highways across India. Revenue comes from vehicle toll collection, annuity payments from a NHIT, and key players are IRB InvIT, National Highways Infra Trust NHIT, and traffic volumes are the key variable. That is, more vehicle equal to more revenue. Next, we have type 2, that is power transmission InvITs. These own electricity transmission lines and substantions. And revenue comes from regulated fixed transmission charges, which are from the state electricity boards like boards and discoms. Key players are Power Grid Infrastructure Investment Trust, that is PGInvIT. Then we have India Grid Trust, that is IndiGrid, and the revenue is highly predictable, that is transmission charges are regulated and fixed regardless of how much power flows. Next, we have type 3, that is gas pipeline InvITs. These own natural gas pipeline infrastructure, the revenue being from gas transportation fees, that is tariff based and regulated. And key player here is India Gas Infrastructure Trust, that is IGIT. And we have revenue predictability is high, and gas demand in India is growing with energy transition. So which type is safest if you ask me? The power transmission InvITs are generally considered the most stable because their revenue is regulated, fixed by the electricity regulator regardless of the market fluctuations. And road InvITs are slightly higher risk because revenue depends on traffic volumes. But India's vehicle traffic is growing consistently. Next, let us come to how much do you need to invest. So this is where InvITs differ significantly from REITs. InvIT minimum investment has historically been higher than REITs. The like we have current listed InvITs and approximate invest levels in 2026. If we see Power Grid InvIT, the ticker is Power Grid, and that is approximate price per unit is 100 to 130 rupees. And if we come to IndiGrid, then it is 140 to 175. And if we come to IRB, it is 55 to 75. And if we come to NHAI, that is National Highways Infra Trust, it is 98 to 120 rupees. And if we come to India Gas Infra IGIT Trust, it is 100 to 130. So minimum lot, SEBI has moved InvIT minimum lot to 1 unit for most listed InvITs. So technically you can start from as low as 55 rupees to 175 per unit for individual units. However, for meaningful income, most investors start with 10,000 to 25,000. Practical example is 10,000 in India, IndiGrid at rupees 160 per unit is equal to 62 units, and at 10% annual yield it becomes 1000 per year is equal to 250 rupees per quarter. And small start but scale it to rupees 1 lakh, and that becomes 2500 per quarter, that is completely passive. Next, let us come to returns, that how much you earn. So now let's talk about the most important question, that is what do InvITs actually pay. So distributed yield, current range is InvITs in India currently offer distribution yields of approximately 8% to 12% per year paid quarterly. And this is higher than REITs, that is 6 to 8%, and significantly higher than FDs, 6.5 to 7%. Why? Means because infrastructure assets tend to have higher and more predictable cash flows, and InvITs pass most of that through to investors. So if you come to individual InvIT yields approximate to 2026, a power grid InvIT has 9 to 11% approximate annual yield. India Grid Trust being 10 to 12%, IRB InvIT being 8 to 10%, NHIAI InvIT being 8 to 10%, and India Gas Infra Trust being 9 to 11% again. So real calculation if we'll do 1 lakh invested, then at 10% yield, annual distribution of 10,000, quarterly payout of 2,500 every 3 months directly in your bank account. At 12% yield, IndiGrid type, annual distribution of 12,000, quarterly payout of 3,000 every 3 months. Capital appreciation, InvIT unit prices also appreciate over time as assets grow and concession values increase. However, InvITs are primarily an income instrument, not a capital growth instrument, except 2 to 5% annual price appreciations on average, lower than REITs or equity. And the main value proposition is high yield plus stable income plus low volatility. Let us have a comparison now. So if you have an investment, let us compare the investment to the yield, to the capital growth, and to regular income and the risk. So FD being 1 to 3 years investment in FD gives you 6.5 to 7% yield and none of the capital growth, and regular income, yes, monthly, and the risk is very low. Whereas REIT has 6 to 8% plus 4 to 12% return yield. It has capital growth as moderate, and yes, it also has quarterly regular income and risk level being low to mid. Whereas InvIT gives you 8 to 12% plus 2 to 5% of return yield, and the capital growth being low to moderate, and regular income being, yes, quarterly you will get the regular income, and risk also being low to medium. Then we have equity mutual funds with 0% yield and capital growth of 12 to 18%, and regular income is nothing, and you have risk from medium to high. Whereas direct property has 2 to 3% yield, capital growth is high but slow, and regular income is, yes, you can have monthly regular income, but the risk is medium to high again. So who wins on income? InvIT is greater than REIT is greater than FD. So InvIT wins. So for pure income generation, if you want the highest regular quarterly income with reasonable stability, InvIT is hard to beat. So 10-year compounding power, like 1 lakh gives 11% total return. So in first year you will get 1 lakh. If you invest 1 lakh in first year, you will get 1 lakh 11,000. In 3 years, you'll get 1,36,763. In 5 years, you'll get 1,68,506. And in 10 years, you'll get 2,83,942. So now let us come to India's best InvITs. So if we come to India's best InvITs, we have first. Let's now look at each major InvIT in India in detail. So first being the Power Grid Infrastructure Investment Trust, the PGInvIT, ticker by Power Grid and listed 2021. The sponsor being the Power Grid Corporation of India, a Government of India Navratna company, and this is government backed infrastructure, about as safe as it gets in this category. The assets being interstate electricity transmission lines and substations across India, 500 plus circuit kilometers of transmission lines. The revenue model being fixed regulated transmission charges paid by state discoms. Revenue is not dependent on how much electricity flows. It is fixed by the electricity regulator, and this makes PGInvIT revenue among the most predictable of all InvITs. Then we have distribution yield being 9 to 11% per year. Key strength being that government sponsor plus regulated fixed income plus lowest operational risk. It is best for conservative investors who want the safety of quasi government backing with income higher than FD, and the risk level is low because among the safest InvITs available. Next we have India Grid Trust, that is IndiGrid, ticker being IndiGrid, listed 2017, India's first listed InvIT. Sponsor being KKR, one of the world's largest private equity firms, global institutional backing. Assets being the power transmission assets across multiple states, 35 plus assets including transmission lines and substations, well diversified across geography and counterparty. Distribution yield being 10 to 12%, one of the highest among listed InvITs. Track record, the India's oldest listed InvIT, consistent distribution since 2017, strong institutional confidence. Key strength being KKR backing plus strong asset base plus highest yield plus proven track record, and best for investors who want the highest income from a well established institutionally backed InvIT, and risk level being low to moderate. Next we have IRB InvIT fund ticker. Ticker being IRB InvIT, listed 2017. The sponsors being IRB Infrastructure, one of the India's largest highway developers. Assets being operational toll road projects across Maharashtra, Rajasthan, Gujarat and other states. Revenue from vehicle toll collection. The revenue dependency being traffic volumes. More vehicles equal to more revenue, and India's vehicle growth rate is 8 to 10% annually. So it's positive for long-term toll collection. Coming to distribution yield, it is 8 to 10% per year, and the key strength here is exposure to India's road traffic growth story, long-term concession agreements. Coming to the risk, higher than power InvITs because toll revenue fluctuates with traffic and economic activity, and best for the investors who believe in India's road traffic growth and want exposure to the highway sector. Risk level is moderate. And coming to moving on, we have National Highways Infrastructure Trust, NHIT, ticker being NHAI InvIT, listed 2021. The sponsors being National Highways Authority of India, the Government of India itself, and assets being the operational national highway projects across India. The revenue being hybrid annuity model, part toll, part government annuity payment. Coming to the key strength, it has direct government sponsor, and it has annuity component, ensures baseline income stability. Next, we have the distribution yield of 8 to 10% per year, and it is best for investors who want government backed highway exposure with annuity income support, and risk level being low to moderate. Government backing provides revenue flow. Next, moving on, we have India Gas Infrastructure Trust, that is IGIT, ticker being IGIT, listed 2022, and the sponsor being GAIL India, GAIL India, one of the India's largest gas transmission companies. Assets being natural gas pipeline infrastructure across India. Revenue being regulated gas transportation tariffs. And India's gas growth story is that India's natural gas consumption is projected to double by 2030. The government is pushing natural gas as a transition fuel. Growth in this sector is policy backed. Distribution yield is 9 to 11% per year, and best for investors who want exposure to India's energy transition and gas infrastructure boom. The risk level is being low to moderate. And if we have a master comparison table over here, will be having PGIT of yield 9 to 11% in power sector, has sponsors of government PGCIL with the risk low and best for ultra conservative. Next, we have IndiGrid with yield 10 to 12% in the power sector again, with the sponsors being KKR. The risk is low to medium, and it is best for highest income. Next, we have IRB InvIT, which has the yield of 8 to 10%, being in road sectors, the sponsors being IRB Infra. Risk is moderate, and it is best for traffic growth play. Next, we have NHIT with the yield 8 to 10% in the sector road again, and it is backed by government NHEI, and the risk is low to medium again, and it is best for government backed routes. Next, we have IGIT with 9 to 11% yield in the gas sector, which is sponsored by GAIL India, and the risk is low to medium, and it is best for energy transition. So my recommendation for the beginners will be PGInvIT because most government backed, and it is more stable too. Then if for the income seekers, it could be IndiGrid because it has highest yield and proven track record since 2017. If you want balanced investors, they can go to combination of PGInvIT plus IndiGrid for power sector diversification. Next up, we have advantages of InvITs. So advantage first will be the high. It has highest regular income among stable instruments, the 8 to 12% per yield per year, and significantly higher than FDs and REITs. Quarterly distribution is predictable, passive income every 3 months. Next, next advantage is that it has backed by real tangible, essential infrastructure, highways, power lines, and gas pipelines that doesn't disappear, and it is essential for the economy, and demand is structural and permanent. Third is that it is SEBI regulated and transparent. So quarterly reports, mandatory disclosures, audited financials, full transparency. So no black box, and you can monitor the performance of every underlying asset. Next, we have fourth being that government support and concession agreements. So most InvIT assets have 25 to 35-year concession agreements, long-term revenue visibility that no stock or FD can match. Fifth being complete liquidity listed on NSE or BSE. Buy and sell anytime during market hours. T+1 settlement, no lock-in. Then we have sixth being the inflation linked revenue growth. So toll rates in India are revised annually based on WPI, that is wholesale price index. So power transmission charges are reset periodically, and your income automatically grows with the economy. Then we have seventh being the professional management InvIT. That is, InvIT managers handle asset maintenance, concession management, and expansion decisions. So you invest and receive income. So there is no operational involvement. Next, we have eighth being the portfolio diversification. So infrastructure has low correlation with equity markets. InvIT, InvIT in your portfolio reduces overall volatility with sacrificing income. Next, coming to the if we come to the disadvantages of InvITs, we have first one being finite asset life. That is, unlike REITs, which can keep buying properties indefinitely, InvIT assets have fixed concession periods. A 30-year highway concession ends in 30 years. Revenue stops unless new assets are added. So, good InvIT managers continuously add new assets, but it's still a structural difference. Limitation 2 is that traffic and volume risk for road InvITs. So, if a new highway bypasses an existing toll road, traffic volumes on the road can drop significantly. IRB InvIT experienced this on one of its key projects. Coming to limitation 3, it's lower capital appreciation than REITs or equity. So InvITs are primarily income instruments. Unit price appreciation is modest, 2 to 5% typically, and if you want high capital growth, pure equity is better. Coming to limitation 4, we have complex taxation. That is uh, similar to REITs. So distributions have multiple components, that is interest, dividend, return of capital, each taxed differently. So it requires careful ITR filing and CA consultation. Next, we have a limitation 5 being less liquid than major stocks. While listed on exchanges, InvIT trading volumes are lower than large cap stocks. Selling large quantities quickly can sometimes impact the price. Limitation 6 being depth heavy structure. That is, InvITs typically carry significant debt to fund infrastructure assets. So, rising interest rates increase borrowing costs, so compressing distributable income. Now, coming to risk meter, that is risks, how safe are InvITs? So overall risk rating low to moderate. Risk 1 being traffic or volume risk, that is medium for road InvITs. So if toll revenue depends on vehicle count and traffic growth slows, income falls. The mitigation is India's vehicle penetration is at 20% and rising. Long term traffic growth is structural. Next we have regulatory risk, which is being low because toll rates and transmission charges are set by regulators. So if regulations limit rate increases, income growth slows, and mitigation is that India has historically allowed inflation linked increases, and this trend is expected to continue. Next, we have interest rate risk, which is medium, because higher interest rates increase InvIT borrowing costs, lower distributable income. So, mitigation is that India is in a rate cutting cycle, that is 2025 to 26. This is currently a positive for InvITs. Coming to risk 4, that is concession expiry risk. That is low for now, because if in assets are not replaced by concessions expire, that is income eventually wins down. So the mitigation is that good InvIT managers actively acquire new projects to replace maturing assets. Now we coming to next risk, that is sponsor risk, which is very low, because um, if the sponsoring company faces financial distress, InvIT governments could be impacted. Mitigation being choose InvITs with government or institutional sponsors like PGInvIT or NHIT or IndiGrid via KKR. Coming to the verdict, my honest verdict will be that InvITs sit between FDs and REITs on the risk return spectrum. So, slightly more predictable income than REITs due to regulated revenues, but with finite asset life as a structural consideration for long term income investors. InvITs are an excellent and underappreciated asset class. Coming to um, the taxation now. Uh, InvIT taxation is structurally similar to taxation. That is, distributions are paid in multiple components. Uh, if you take interest income, the tax will be in interest income. It is taxable at your income tax slab rate. You take dividend as a component, then the taxable at it will be taxable at slab rate if 115 BAASPV. Then if you take return of capital, it will be not taxable, reduces cost of acquisition. Now coming to capital gains on scale, holding period, if it is under 12 months, the tax type will be STCG and rate will be 20%. And if it is over 12 months, it will be all LTCG and 12.5% on gains above 1.2 rupees 1.25 lakh per year. So budget 25 update is that LTCG on InvITs was also brought under the beneficial 12.5% rate, significant improvement for long-term holders. And ITR filing, ITR 2 required if you have InvIT income. Then key takeaway is that hold for 1+ year to access the 12.5% LTCG rate. Consult a CA for the distribution breakdown. Each InvIT publishes the tax components split quarterly. Next, we have how to buy and sell InvITs. So, buying InvIT units is identical to buying any listed stock. Step 1 being open Zerodha, Groww, Upstocks or Angel One. Step 2 being search for InvIT by name or ticker, PowerGrid, IndiGrid, IRB InvIT, NHAI, iGIT, anything. And step 3 being place a buy order, market order, which will be instant or limit order at your price. Step 4 being units appear in demat account by next business day, T+1. Then step 5 being quarterly distributions credited automatically to your bank account. Selling is selling will be like same process. Go to portfolio, select InvIT, click sell, enter units, place orders. It will be T+1 settlement, no lock-in, no exit load. Then we have investment strategy. For beginners, start with 10,000 to 25,000 in PGInvIT. Intermediate one can split across PGInvIT plus IndiGrid for power sector diversification. And income seekers can add IRB InvIT for higher yield with some traffic growth upside. Next, we have a comparison with InvIT versus other investments. So, if we go to comparison, we'll have InvIT minimum investment in InvIT being uh, the minimum like investment being in an InvIT. InvIT will be 55 rupees 55 plus. For REIT it will be rupees 120 plus. For FDs it will be 1000 plus, and equity it will be 500 plus, and gold it will be 5000 plus. So yeah, very lowest minimum investment can be in InvITs. Then coming to yield, InvIT gives 8 to 12%, REIT gives 6 to 8%, FD gives 6.5 to 7%, equity and mutual fund and gold will give none. Coming to capital growth, we have for InvIT it is 2 to 5%, REIT 4 to 12%, and equity mutual funds being 12 to 18%. And coming to liquidity, we have InvIT has like all InvIT has exchange. InvIT REIT and mutual funds equity has exchange, gold has moderate, but FD has penalty. Coming to income frequency, for InvIT we have quarterly, InvIT and REITs we have quarterly, FDs we have monthly, equity MF we have rarely, and gold we have never. Coming to risk, InvIT has low to medium. InvIT and REITs both have low to medium. FD has very low. Equity and mutual funds have medium to high, and gold has low medium. Coming to low to medium, and coming to asset type, InvIT will be infrastructural, REIT will be real estate, FD will be bank deposit, equities will be equities, mutual funds also will be equities, gold will be commodity. So verdict is InvITs win on income yield, REITs win on capital appreciation, FDs win on safety, equities win on total growth, and ideal portfolio includes all four. Coming to current affairs or market connection, um, why is 2026 a great year for InvIT investing is that India's national infrastructure pipeline NIP gives rupees 111 lakh crore infrastructure spending target by 2030. Roads, railways, power, gas all accelerating. More infrastructure is equal to more assets for InvITs to acquire, which will be giving more income over time. Second being that RBI cutting cycle. So lower interest rates is equal to lower borrowing costs for InvITs is equal to higher distributable income. So exactly what happened in US REIT or InvIT market when the Fed cut rates in 2024. Next, third one being that India's highway network expansion. So India is building 50 kilometers of highway per day, a global record, and more operational highways gives more assets for road InvITs to acquire. Next, we have fourth one being power grid expansion. That is, India's power demand is growing at 6 to 8% annually. The transmission grid must expand to match, and PGInvIT and IndiGrid are indirect direct beneficiaries of this structural growth. Fifth one being natural gas demand growth. India's city gas distribution CGD expansion means more gas pipeline demand. IGIT is perfectly positioned to benefit. Sixth being institutional interest, because insurance companies and pension funds are actively increasing InvIT allocations. Institutional buying provides price stability and long-term confidence. Coming to 8 key takeaways to remember, being the summary, like I'll give what is my summary is quick recap of everything you need to remember is what is InvIT. It is a SEBI regulated trust owning highways, power lines, gas pipelines, and it distributes revenue to investors quarterly. Coming to types, it has power transmission, which is safest, road, highway, and gas pipeline. Coming to returns, it has 8 to 12% distribution yield plus 2 to 5% price appreciation, which is equal to 10 to 17% potential. Coming to next being best InvITs in 2026, it is PGInvIT, safest, IndiGrid, highest yield, NHIT, which has government roots. Risk level is low to medium, most predictable than equity, and more income than FD. Tax being LTCG being 12 to 12.5% over 1 year, and distribution at slab rate, and file is ITR2. How to invest is Zerodha or Groww, same as buying a stock, minimum 1 unit. Why now is rate cuts plus infrastructure pipeline plus institutional energy is equal to perfect timing. Now, if you learned something new today, hit that like button right now. It takes 1 second and genuinely helps this channel reach more people. Drop in comments which in which are you most interested in. I read every single comment and reply. So subscribe and tap the bell. Every week I publish detailed, honest finance guides like this one and share with someone who keeps asking how to earn regular income from investing. InvIT might be exactly what they are looking for. See you in next video. Take care. Thank you and bye bye.